Next up, we're going to talk about how to position equity to our clients. And to do the honors is a man that we have all seen in TV at some point in time. None other than Ambareesh Baliga. Ambareesh Baliga has over 35 years of experience in stock market and financial consulting. He is a cost accountant from Kolkata from the Pricewaterhouse and later worked with a lot of financial services companies right from Kotak, Karvi to many of the other big names in roles from wealth management to fund management to various others. So he is an acknowledged financial expert, especially of the stock market, and his acumen on especially stocks is well sought after. Today, Ambareesh is an expert acknowledged by all the newspapers and media and consults many mid-sized corporates on their strategy and their equity investing opportunities. Over to Ambareesh Baliga to give us how to position equity to our clients.
Okay, Babu, thank you so much for that wonderful introduction. Yes, it's really a honor to have you, Mr. Ambareesh, here with us for this annual meet. It's really exciting. It is our endeavor to bring in speakers who can really get that rich knowledge shared across with our community. And we are extremely happy to have you, sir. Welcome for this wonderful event.
Vasudevan, thank you for having me, and it's really an honor to be addressing all of you.
Oh, great. So let's start off. This is going to be a question and answer. We have selected shortlisted few questions, and I'll be throwing some of them at you. And we expect your experienced answers for them. Thank you so much. In fact, the first question is going to be something really interesting, a question and answer for which I haven't heard any time in the recent past. So here it goes. Sir, what do you think are the reasons that Indian stock market will not go the way Japan did?
See, first of all, India and Japan really cannot be compared in any sense, as they are totally different in all aspects. Japanese economy and markets peaked out in 1989. I mean, close to what, about 30 years, 32 years back. And during that time, everyone thought they could get rich and good times would continue forever. Then there was an asset bubble, which actually blew up. Now, if you look at the population, the demographics, close to about 29% of the population is 65 years and above. And I suppose by 2035, 2036, people above the age of 65 would be about 1/3 of the population. So this is a population which will not be earning, will actually be only consuming. And if you look at the economic growth in Japan, I mean, since 1980 to 2021, if you look at the GDP growth, it's about 0.44%. And if you look at the population growth from 2011, it's been decreasing. It's not increasing. It's decreasing. Now look at India. I mean, India has a growing population, though the growth rate has come down to a certain extent. And if you look at the demographics, just 7% of our population is above 65. Majority are in the working class, which is 18 to about 64. That's about 67% of the population is working, earning, and consuming. True. When you're earning and consuming, you're actually consuming much more than what you consume post-retirement. And another 26% is from absolute babies to about 14 years who would be coming into the working age over the next few years. So ours is a growing economy. It's only by 2035, 2040, where we'll see the older population increasing, but it'll be nowhere it'll be nowhere near where Japan is even today. So clearly, we are looking at a growth economy here. And again, there's a major shift also which is happening from rural to urban. And I suppose by 2035, we should see about 40% of the population in urban areas, as against about 30% in 2011. So that's a decently good shift. So, like I said, ours is a growing economy at least over the next 2 decades with a young consuming population. We are actually trying to become the suppliers to the global industries. And in fact, this should be the beginning of a golden era. And I mean, as we move towards that $5 trillion economy, and surely much more by whatever 2030, 2035, it should be much more. And remember that there would be mini bubbles. I mean, it's not going to be a one-way street, and anything and everything can't really move up all the time. So one has to be a bit careful in selecting your investments. But overall, I think we'll see a stupendous growth.
Wonderful, wonderful. That sums up. So a young population and shift from rural to urban, you feel is the key that we will never go the Japanese route. That brings us to another interesting question. See, how do you think the inflationary environment in the developed markets, how do you think that is impacting our Indian economy and particularly our Indian markets, Mr. Ambareesh?
See, it's going to be an inflation environment in India too. I mean, with the crude going through the roof, and we are importing about 85% of our requirement of crude that's getting imported. So we'll surely bear the brunt. And recently, even the finance minister said that the crude price is a risk to India's financial stability. Though I would assume she wanted to put forth the dangers, but looking at our economy, our forex reserves, and I mean, overall sort of a growth which we are looking at, I don't think it can destabilize India's finances. But yes, I think it'll be a strain for some time. And like I said, fortunately, ours is a growing economy, and such an economy creates wealth in the longer term, provides better employment opportunities. So this inflation actually gets absorbed in that growth. So in the short term, yes, it would have some negative effects, no doubt. And we have already witnessing that to a certain extent. I mean, if you look at the last quarter results, there has been margin pressure across various industries, across various companies due to increase in raw material prices. Now, Fed is expecting to hike the rates quite soon. So FIs have been net sellers, which again is exerting further pressure. RBI too is expected to increase rates in the next meeting. So from a market perspective, it's a short-term negative, but I suppose it's an opportunity for investors.
Okay, that brings me to the next important question. As you rightly pointed out, Mr. Ambareesh, FIs have been pulling out money in a big way over the last 1 year, and we see the trend continuing. Do you see that this money could sometime in the near future come back to India? Any near future time?
See, I mean, first of all, FIs have been major investors in our markets for the last 3 decades. I mean, they held more than about 20% stake in Nifty 500 companies. The last 24 months, again, we have seen a stupendous rise in our markets. So it's quite natural that they will book profits. And that's why we have seen nearly 1,72,000 crores of selling from FIs, and that continues. I mean, we have seen this selling since October 2021. Also, the expectation of a rate hike has been there for a while. So typically, whenever this happens, whenever there's a rate hike expected or it happens, FIs pull out of the emerging markets, and these funds actually flow back. And again, normally those who are selling large blocks also see and check out whether their selling can get absorbed in the market without really a major damage, because if there's a price damage, they also suffer. But then,
in fact, but another interesting fact that is happening in the Indian markets that we have not witnessed for a long time is the domestic institutions have been observing whatever that FIs have been selling. Exactly. Domestic institutions have been net buyers. That is one factor which is kind of holding up the market and not letting the prices correct.
Exactly. I mean, this is what has been happening in the last 2 years, that it's the retail money which is coming in. So retail investors are investing in a big way. I mean, we have had about 6 crore investors coming in the last 24 months, 5-6 crore investors coming in the last 24 months. And I mean, they are investing directly in the market as well as through mutual funds. So end of the day, mutual fund are buyers, but whose money is it? It's retail money.
Retail.
So, because of so much of liquidity, there is not much of price damage. And because of which these FIs have been able to sell. And they're actually utilizing that opportunity. Yeah, but then at the same time, I mean, FIs are not there to exit and run away from India. I think at these levels, they are finding the markets fully priced. They've made good profits. That's the reason they've exited. But surely they'll come back at an opportune time.
So it's more of a profit booking, which is a natural phenomenon that is happening. And once they find the prices attractive, they will definitely come back to India and do invest. That's what you're feeling,
Absolutely.
right?
Absolutely.
Wonderful, wonderful. Thank you so much. And about this climate that is happening between in the Ukraine, how do you think this is going to pan out? And would this be a factor for the markets to have a long pending correction creep into the market? Would this, how do you think this will play out?
No, I suppose that this could be a catalyst for the markets to correct, which they have not been correcting in the last 24 months. And there are enough reasons for the markets to correct. So that's the reason I'm saying the Ukraine issue could be a catalyst. Because the other things is like we just discussed a while back is inflation, which is dogging. I mean, most of the economies across, including India, especially with the way the oil prices are going. So at the same time, because of the Ukraine issue, will further have supply chain issues, which I think we have already seen during the COVID times that the supply chain issue had fanned the inflation. And again, we'll see supply chain issues from Europe and Western countries. So I think overall, this will be inflationary. So markets can be expected to correct further from here. But like I said, I think it's an opportunity because long term, clearly, India is a growth story. And one should utilize any decent or deep dips in the Indian markets to buy.
So wonderful. The takeaway is buy on dips. That's what you feel. But should an opportunity present, don't hesitate to go ahead and buy on dips. Wonderful, wonderful. Now that talking about the Ukraine environment, how do you think the commodity prices are going to be impacted, and where would you actually put in your money as this pans out and as the effect of this situation hits the market?
See, commodity prices have anyway already moved up. I mean, other than oil, I do not see, to me, the commodity prices really shooting through the roof, except due to the supply chain issues, possibly you could have a further rise. But that, again, will not be too long term. Even oil, I expect that once this issue gets over, maybe the next 6 months or next 9 months, I will not be surprised if we see oil back at $60-70.
Wow.
Yeah.
Okay.
And if you're talking of which are the sectors which possibly could outperform as far as India is concerned, clearly government focus is there on Make in India and infrastructure. So many sectors connected to this focus area will really do well. I mean, for example, infrastructure companies as well as infrastructure ancillaries like cement, I think should look up. Automobiles, which had a slow year last year, due to shortage of semiconductors, I think that sector should really look up this year, especially passenger cars. And I suppose it will also get a fillip from the infrastructure sector as demand for earth-moving equipments, heavy commercial vehicles, then last-mile commercial vehicles. I think the demand for all these will rise. Engineering and defense companies, I think, will benefit with the Make in India program, which will actually give them an edge against imports. Specialty chemical sector, again, had a stupendous move in the last 2 years, but the last 6-8 months, we've seen some softening. But I still expect this China plus one story to play out well as globally supply chains continue to scout for alternatives. And India clearly has proven itself as a reliable manufacturing base for specialty chemicals. And in some of the specific chemicals, specialty chemicals, we are actually leaders.
True.
So the other sector which clearly I think will do well over the next few years is real estate. Because like COVID has pushed people to move to bigger homes with better lifestyle, better infrastructure. And people don't mind moving away from the city center due to better e-connectivity. So affordable housing has got a major boost. And I expect that to continue. The last 5-6 years, the demand was slow because those wanting to buy were actually waiting for prices to come down. But now that's not happening because prices are slowly inching up, not because the real estate prices are moving up, but because the input cost is going up. So input cost pressure is there, because of which the property prices have started moving up. So everybody now is jumping into buy.
So you're betting big on infra and real estate as it happens like every bull run, there is a new sector which takes the lead and moves forward. So this time you're predicting that it's going to be infra and real estate, which is going to be the catalyst.
Exactly.
Wonderful. Thank you. And see, off late there has been a lot of but these passive funds are really attracting a lot of crowd. Are we going the Western way? Would passive funds be more garner more funds than active funds in India? How do you see this panning out, Mr. Ambareesh?
That's possibly true because passive funds, I think, are the best for beginners. And it is comparatively low risk, for those who don't want to take too much of risk in the equity markets. So I think that's perfect for such people. I believe that the passive funds should actually be the bedrock of one's equity mutual fund portfolio. And if you look at the performance as a whole, active funds have beaten or outperformed by a very small margin in the last 3 to 5 years. So what I would say is that one should shift to active funds based on the broader view. For example, when you expect a secular up move, exactly like what we saw from April 2020 till about 2-3 months back, one should shift to active funds as they tend to outperform in a big way during such times. And again, it also depends on how well you choose your fund or fund manager. I think that's very important. And when you get uncomfortable with valuations, like how it was in the last 5 to 6 months, but then again, don't want to reduce your exposure to equities, and then I think one should shift back from the active funds to passive ones. But it's easier said than done. But
very true.
But but even if you are able to get a part of the move right, I think you can improve your returns tremendously and also cushion your portfolio from a downside.
Okay, that leads me to the next question. What do you think are the indicators? All of us would like to know that we would like to buy low and sell high, but often, as you correctly said, it's much easier said than done. How do we indicate that the bull market is ripe for booking profits? What are the few indicators that you look at, and what do you think that advisors should look at? Could you please elaborate on that, please?
I think as a long-term investor, there is just one indicator which I look at. I think greed and fear are the big indicators that the markets, where the markets are going, whether it's bullish or bearish. When a bull market is in rage, you will hear lots of people telling you that this time it is different. But just remember that the underlying story or behavior of greed and fear remains the same. The actors change, the storyline is the same, the screenplay changes from time to time. However, it doesn't really play out immediately, thus one needs to have a lot of patience. Going back to the recent past, March 2020 was when fear was at the maximum. People were selling off their portfolios. Yeah, it was at the peak. people were selling off the portfolio as if it's the end of the world. Yes, I
True.
mean, at that point of time, we got hit by a situation which none of us have experienced in our lifetime.
Very
So
true.
the ensuing panic was an extremely great opportunity. And let me tell you, I mean, surely, I mean, like I was also a bit fearful at that point of time, but I mean, I was able to gather that courage and buy to a certain extent. I didn't buy whatever I wanted to, but I bought to a certain extent.
So same story everywhere. Yes,
Yeah,
we did dip our hands, but not fully grab it. Very
exactly.
true.
Yeah. So similarly, in the last few months, I mean, I've been having that feel of over exuberance. I mean, making money seemed so easy. Like I said, I mean, more than 5-6 crore new investors had come in. They had opened demat accounts, and most of the people made money initially. I mean, initially in the sense, I would say even 18 months, I think people really made good money. So naturally, the confidence levels were high that nothing can go wrong. Uh, I mean, buy anything and it will go up. I mean, this is when greed comes, and
True.
that was quite visible. So, I mean, people are saying, let me make, I mean, whatever money I can in the short term. So, people withdrew from their fixed deposits and other asset classes and invested in the equity markets. So,
True.
naturally, a sort of a mini bubble gets created, and that had to correct. So, possibly this Ukraine issue was, like I said, one of those reasons, one of those catalysts. But as a long term investor, I don't think we should try to time the market. We can never time the market, but
True.
one should ignore. I mean, this. I mean, should not really ignore this over exuberance or panic, and possibly utilize those opportunities to exit the markets as well as invest in the market.
Okay. So set aside your fear of missing out. Particularly this fever catches up only when the market is at peak, and that
Exactly.
leads to greed. And be rational and don't get carried away. Both bull markets and bear markets are not here to stay forever. So these are cycles that play out, and be prudent enough to trim your profits and wait for an opportunity to re-enter. That's your
And I suppose the most important thing in this market is not fundamentals; it is investor psychology.
the liquidity, the greed. You correctly said it. The
Yeah,
greed and the fear,
absolutely.
aggregate of greed and fear is what the psychology comprises of. True. So now we all feel that, people are chasing. Yes, the ideal time, it's like the greed is, blown out of proportion. I don't know, but probably this Ukraine thing could puncture it and bring down the market, correct for a time being. But let's hope. We don't know. And I think we have time for one more question, Mr. Ambareesh.
Yeah.
So do you recommend tactical asset allocation as a play out for people who are managing investors' return? Because most often investors look at returns, and what they want from the market is only returns. For all that we know, 2022 might not give big returns for the investors, but on the other hand, might give good opportunities to invest so that you can make good returns in the following couple of years. So, how important it is a tactical asset allocation to be followed by an advisor, in your opinion, sir?
No, see, this again depends on the requirement of the investor, because see, everyone wants to make money.
True.
But I mean, as an advisor, as a mutual fund distributor, I think we should find out as to what is good for him. I mean, we are just like a doctor, possibly. Do you give the right medicine as per the ailment of the patient, or do you prescribe the medicine which is being pushed to you by the medical representative or the pharma company? Though it may not kill the patient, but it may not be the most appropriate one. So I think we need to understand what is good for the investor and act from that point of view. I mean, like again, if you're talking of sector funds, I think I mean, if you need to invest in a sector fund, I think we need to catch it early in the cycle. And I suppose one way of knowing when is the end of the cycle for a specific sector is when you have too many NFOs coming in for the specific sector. So that's very clear. At that point of time, you should possibly be exiting those.
Okay, just like what's happening right now, We have one of the biggest IPO also line. So I think we have come to the end of our wonderful discussion. Thanks a lot, Mr. Ambareesh, for locating time from your busy schedule and joining us today for this annual convention. We are extremely happy. Thank you so much, sir. Have a great time.